You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from a little thing we like to call around here, the old Options Insider Radio Network. Nice to be back in the old studio again this week after a bit of globe trotting, or at least country trotting down to the old risk management conference last week. It's always fun to get out there and see some of the new studies and new data and meet a lot of the managers and people who are out there in the weeds trading this fun stuff. But it's also nice to get back here in the old studio so we could live stream for you guys and all the other fun stuff we like to do. Speaking of which, if you're not doing so, follow us at Options on Twitter so you can see when our live stream link goes out. Of course, you can always just follow us on Mixlr, MIXLR, grab the app for your mobile device, or just go to the webpage there and you can listen to our broadcast. And they are live Mondays and Thursdays, 3 p.m. Central, 4 p.m. Eastern for the option block, and Fridays at noon Central, 1 p.m. Eastern for Vol Views, at least for now for our live stream. We hope to augment that with more shows in the near future, but for now, that's kind of our base live streaming schedule. So if you're not checking us out there, by all means, do so. We'd love to hear from you guys. And of course, you can listen to our on-demand stuff, pretty much all the usual places: iTunes, TuneIn, Stitcher, etc., so on and so forth. And of course, you can always grab our mobile app, available for iOS, Android, and even the ever-popular, beloved Fire OS. And joining me on the old program again today, I think if the Skype gods are smiling upon him, is the soon-to-be Mr. Dr. VIX, he of corner office fame / infamy, Mr. Russell Rhodes, a senior instructor over there at the Options Institute at the CBOE. Mr. Rhodes, welcome back to the program. Did you make it back from Florida in one piece, sir?
I made it back from Florida via Oklahoma. And I am back in one piece. And I'm looking forward to going back down to Florida next week.
Yeah, another show next week.
FIA. I'm pretty
the big,
excited. You were saying that you like when they're back to back so you can just stay down there. I'd rather have two trips than one.
You like to have the two trips going. Yeah, well, that's true. For you, scamming two trips makes sense. For me, it's just easier from a logistical perspective to do the one and get it done. But hey, if I have to do 2 trips to Florida when it's still relatively chilly, a little bit nicer here in Chicago now. When we were in RMC, though, it was snowing in Chicago. So there were worse times to be cruising around in Florida, top down, than there were a couple of weeks ago. But still, and I know a lot of you guys wrote in with some interesting questions from RMC. We will get to those forthwith. That noise you hear in the background, listeners, means I am joined in studio by the Greasy Meatball, who will be joining us very shortly. But first, let's keep on rolling with the show right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. Welcome to the Volatility Review, the portion of the program here where we break down what caught our eye, what was moving, what was shaking in the week that was from a volatility perspective. And that noise in the background, listeners, means I am now joined, better late than never, by the Greasy Meatball himself, Mr. Mark Sebastian, who's apparently becoming a permanent resident here in our newly revamped studios. Mr. Greasy Meatball, welcome back. It has been too long. What's it been, about 14 hours or so since you were...
Almost 14 hours.
Since you last darkened our door here in the newly updated Options Insider Studios. And I'll ask the same thing I asked to Mr. Russell Rhodes. Did you make it back from Florida in one piece, sir?
I did make it back from Florida in one piece, albeit a lot later than you guys, because I stayed there till Monday morning. You know, got a little golf in, got a little swimming, went to the beach. All in all, a great time. And I'll tell you, I know we talked about it again, but as I get a step away from that conference, I learned a ton. It was just a great conference. And folks, if you really want to learn about volatility, even if there's value I see retail traders pay, thousands and thousands of dollars for this is less than that, and you will learn way more about how the professionals trade than you'll ever learn from even a jerk like myself.
There are a lot of professionals there. Let's see how they like to sling, or sometimes in some cases don't sling, or in the case of last week, sell puts. There was a lot of that going on there, but a lot of interesting stuff. We'll get to that. I mentioned to Russell we have some good questions about our follow-up and our rundown from the conference. We'll get to those a little bit, but first, it is indeed the Volatility Review, the portion of the show where we break down what we saw in the week that was from a vol perspective. We are recording this on Friday, March 11th, right about the middle of the session for all of you playing the home game after the fact. Don't have the fortune to be streaming us live here. And it is, I think, to say charitably or to easily say, it's a bit of an up day on the old street today. Most of the major indices up well north of 1%. S&P leading the charge, up nearly 1.5%, or about 27 odd handles right now. The Dow up over 1%, about 200 handles. And the old Qs up about 1.3%. And of course, with all of this upside love, VIX cash taking a bit of an exhale today, shall we say, coming off of those midweek upper teen highs here, right about 16.3 or so right now in the VIX cash, off about 1.3 handles or so. And while the Greasy Meatball gets situated, Mr. Rhodes, we'll turn to you here. What caught your eye? A lot of stuff kicking off this week. What caught your eye in the week that was from a volatility trading and analysis, and even from an Oklahoma perspective? You want to throw that in as well?
Well, there's nothing much to report from Oklahoma with respect to volatility. I can't remember if I came on the time that my cab driver noted that we were moving into a high volatility regime or not. That even the Tulsa cab drivers were aware of that. But
the Tulsa cab driver asked you if you were in a high volatility regime? Really?
No, he told me we were.
Oh, wow. Okay,
No,
sell everything and get the hell out of Dodge.
Wow.
It was in November. It was my last residency in Oklahoma. It was because I know it was before I went to RMC Asia, and it was actually my Uber guy. He was a retired investment banker out of New York that was driving Uber in Tulsa, and he goes, this sounds so. He knew who I was, and he goes, "Oh, So what do you think about this shift into the high volatility regime? And I was like, oh my gosh, I can't get away from this. Uh, so I think we're still there despite VIX coming down. We've still got VVIX, which is the thing that stands out to me an awful lot, up in the up in the 90s, I think, today. And then the shorter dated volatilities relatively low. I mean, but of course, this time last year, we wouldn't be calling VIX in the 16s low, And
Russell, I would make a comment that a couple of weeks ago we were right here, and the S&Ps were 50, 75 points lower. So despite the fact that the S&P is up 75 handles, VIX is in exactly the same place. So, even though the VIX is saying the volatility is the same, when you have a similar volatility of a higher number, it actually does denote more volatility.
No, it absolutely, and it's just amazing to me how it's held up despite what we're seeing in the equity markets. The other thing that I noted in my blog over the weekend, the longer VXV and VXMT, the 93-day and 184-day volatility indexes, those guys are still elevated. So it's not like maybe we're out of the woods for the near term, but looking farther out, I think the market's still got a cautious outlook for the equity market, at least when you look at the longer dated volatility indexes.
Mark, what was your takeaway from the week that was from a volatility perspective?
Yeah, I'm with Russell. I absolutely noticed VVIX going up. I mean, this time when we were leaving in RMC, I think VVIX was below 80.
Yeah, it was in the 70s.
Yeah, and it got for the first time in months and months and months. And now it's quickly turned around back into the 90s, which denotes that, despite the big rally, despite the nice move in the S&P, a lot of the smart paper is stepping in and starting to trade VIX options and step in and buy VIX to set up different hedges. I think it points toward a level of uncomfortableness at these lofty S&P levels.
Yeah, we hit about a high of about mid-90s or so, 95 or so yesterday as we were recording. The option block here, that's when VVIX seemed to be at its apex there, kind of coming off a little bit now, not surprisingly, given what we're seeing in the marketplace. We're at about a 92 or so level right now. Earnings season, we talked about earnings vol before, not much really earnings vol to speak of, unless you're talking about the monster. That is, of course, Dollar General. We joked about it a little bit on the option blog yesterday, but this thing was just lighting it up like crazy over here on the old takeoff yesterday, rallying about 10% on the earnings. I don't know, Mr. Rhodes, I know you like watching volatility from an earnings perspective. In between your gallivants back and forth to Oklahoma and back, did you have a chance to check out the madness that was Dollar General? And anything else on the earnings front catching your eye?
I was actually teaching a class to college kids and talking about earnings. The only thing we had to look forward to was Dollar General this week. And I mentioned how efficiently the market tends to price in earnings, a potential earnings announcement, and noted that the at-the-money straddle for Dollar General was pricing in like a 4% move, and the stock normally moved 4% off of earnings, and I hope none of them are paying attention now to what the stock's been up to after earnings.
Yeah, the beast that is Dollar General. When you're pontificating at length about Dollar General, that earnings season is a bit winding down, yes, shall we say? But it is a fun one. Nevertheless, a lot of stuff cooking off. Anything else catching your eye vol-wise from an earnings perspective or straight equity before we dive into everyone's favorite segment, Russell's Weekly Rundown, Mark?
And where's GVZ right now? Because that's the other one I've been watching besides oil. So oil vol, is telegraphing that really a lot of the big movement is over, even if it's going to go lower itself. GVZ is still really elevated. So there's still some, while not explosive like OVX was, but GVZ still in a position to move around some. When I look at oil vol, I mean, all I want to do in oil is continue to look at things like short time spreads, short, 1x2 put spreads, things that maybe allow me to have a little bit of gamma, but be net short as much vega as possible. Because, if you look at 2008 as a example of what could happen with oil, relative to equities. There, that's the last time we saw a VIX get into the 80s was 2008 and was the S&P VIX. If you're looking at the oil VIX coming from 83, it's going to be a 6-month process to get back into the 20s, but it's going to be being short vol will pay long term, and that's a trade that I like is short oil vol.
It's interesting that you mentioned that it's going to take a while for it to ease back down. When we got the first big move down in oil, and I haven't updated my numbers on this one, so I don't know where we're at now. But I think oil started to fall apart in September, October, something like that, a couple of years ago. The first 6 months that we had the increased volatility in oil, 5 of those 6 months, the realized volatility was greater than what OVX was pricing in. And that's one of the reasons that OVX remained so high was because, the market makers, despite all of the volume and volatility, they had still been underpricing the options. And I think that's another reason that it stays at the level it's at now. You're talking about selling premium. The thing that scares me about that one is that to the upside, the skew is pretty flat for oil options. All the skew seems to be to the downside, and that's the direction that's the direction I'm still concerned about, which of course is easy to say today, but that's the concern that's what I would be worried about. Is you got great volatility and great time decay opportunities here. I'm just worried they just mostly are to the downside, and I don't know if the downside move in oil is over or not.
Yeah, OIX and OIV and OVX both hovering around the low 50 handle range right now. And as you were talking, Russell, almost like by magic, I pulled up here a skew chart here of WTI, because that is something we have been watching. I was going to save it for later in the show when we did our crude oil breakdown. Might as well do it now. We can mix it up a little bit here on the old program. Crude vol is certainly top of mind for a lot of people right now. And looking here across the term structure all the way out to the end of this year and beyond, you're right. We've been waiting for a while. A lot of people have been waiting for this kind of inflection point where the calls were going to get some life. And you can certainly see here, Mark, our listeners can't. Maybe we'll include a link in the show notes by our friends over there at Quick Strike. Love their platform. And the call is getting a little bit more life than they have, but you're right. They're still, compared to anything put wing oriented, the premium is still markedly to the downside. And that goes out pretty far. It goes out to the end of the year and beyond. People are loading up on puts in the 27.5, 25, 24 range, which is going all the way out to the end of the year and beyond. So there still is that market concern for the downside. I mean, that's, of course, factoring out the near front month stuff. Front month's kind of crazy. People are buying all sides of the spectrum there. But factor out the noise, get to the signal part a little bit farther out, and there still shows that there's still some structural concern here, Mark, when it comes to crude oil, at least for the near term. We haven't hit that moment yet everyone's waiting for when the calls are in play and the bulls are back out in force. People thought last week for a while it might start getting there. The calls were feeling some love. I think it was like last Wednesday or so, and then kind of just filtered away and died.
Yeah, I mean, at this point with oil this low, I think that the natural longs are going to want to see a real move, well above above 40 before they step in and start buying calls, and natural shorts, or natural long oil are going to really want to see, natural short oil are going to really want to see some movement above 40 before they step in and start buying calls. So your fuel buyers, your oil buyers, jet fuel, you name it. But your hedgers, they're starting to get to a point now, especially with oil up here, your producers, where it's time for them to start stepping in. And, if you're worried about oil going to 20 or below 20, the time to step in and buy your puts is with the OVX in around 40 as opposed to 80, and oil $10 higher than it was 2 weeks ago.
All right, with our crude talk tabled, at least for now.
Well, there's always crude talk when I'm in the room.
That's true. Very crude indeed. But now, speaking of crude things, this is kind of the opposite of that, because it's time for, I know, Mark's favorite segment. I get a good chuckle out of it as well. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
All right, everybody. That tune still brings a Mark didn't even hear it. There's no speakers. There's no speakers in the studio here for him on that, and he still is laughing to himself, Russell. So it cracks him up. All right, Russell.
Think about it. It's one of those things that makes me happy.
It does.
You know?
Brings a nice smile to the face. All right. That said, Russell, I know you've been gallivanting to hither and yon, Oklahoma and back, but what caught your eye this week in a weekly VIX options perspective, sir?
The open interest for these things just continues to be off the charts. And even though next week is a standard expiration, you'd expect things to be kind of dipping down. But we've had 6,000 of the March 23rd 17 puts trade today. I think they were leaning on I think they were leaning on the offer side of those. And so maybe they're thinking that we're going to stay at a lower level of volatility. But the other thing that's really interesting is you've got decent open interest for the March 23rd, 23s, 24, and 25 calls, and then even up to the 29s. So, maybe with very little time left to expiration, on a pretty regular basis, people are taking a look at, out of the money calls on VIX that are on non-standard expirations to try to get some exposure. You've already got open interest for the March 30th options up to around 40 or 50, about 50,000 contracts eyeballing it really quickly. So, the volume continues to move up. It seemed like for the first few weeks, there was only one or two firms that were really involved in these. And they say liquidity begets liquidity. And it seems like more and more people are starting to latch on to the weekly VIX options.
Yeah, and how about the Wednesday weeklies? Have they garnered much interest yet?
They've had tons of interest already. In fact, everybody's going to pledge not to get me fired, and I'm not going to give the specifics at all. But I'm planning on putting on my first trade with the Wednesday weeklies today. I'm just going to take a look at doing something with the intent of holding it through next Wednesday's close. Those options right there have. Today they've traded, about 20, 30,000 contracts or so. And, maybe it's a tough, we've been doing more than that on a pretty regular basis, but maybe, the fact is that that's a Fed announcement, if I'm thinking correctly. And, maybe because there's a Fed announcement, and a lot of people want to use shorter dated index options to take advantage of time decay, that they're actually staying out of the way for that expiration. If you think about it, we've never had options expire less than 2 hours, or index options expire 2 hours after the Fed announcement, and that's kind of a nervous thing to try and get in front of, I guess.
The only thing I've ever seen like that was I think we had a really important Fed announcement around a VIX expiration one time, similar to kind of what we were getting here. Although I don't think this one's as important as some other ones we've had in the past, but it's going to be really interesting to see how the actual S&P index performs, because it's not the same as vol. It's a totally different type of trade.
Mark, have you put on your first Wednesday weekly trade yet?
I'll be honest. I've not put on my first Wednesday weekly trade yet. It is something I intend to do. As you know, the only thing I like more than Fridays is Wednesdays, because that means I'm over the hump. So I think we need to start calling these hump trades.
Yeah. Bring that up with CBOE branding. I'm sure they'll be all over that.
What do you think, Russell? Hey, how are these hump weeklies?
The hump options. Hey, looking a little bit farther out on the weekly, since we switched over to SPX here, since we have quarter end options and weeklies, we actually could almost say that we have dailies for March 31st and April 1st.
Oh yeah.
Oh yeah.
Back. So you really want to thread the needle. You might want to take a look at the March 31st, and they're both PM settled SPX options. The March 31st quarter ends versus the April 1st. It's been a while since I've updated these numbers as well, but I think the first day of a month, we have like a better than a 60% chance of the equity market moving higher.
There you go. So all the people out there beating the drum for the dailies, they get a little bit of pick of their poison now. Not just the weeklies expiring, but now we have those quarterlies coming off as well. Speaking of overall VIX options volume, been a fairly, I think you can call it a robust week. From a volume perspective, ADV hovering right around that 600,000 or so mark that it's been at for some time. And we had a couple days this week we're at it or a little bit above. Thursday hitting it, and Tuesday about 871,000 or so. So a decent volume weekend. So far today seems like numbers are pretty strong. Hitting that ADV already, about 633,000, having gone up by noon today so far. So it seems like today is off to the races. We'll see. I guess some of that upside love being felt out there in VIX land. I think part of that volume, I don't know, Mark, if you saw this trade going up, a bit of a funky one going out. It looks like perhaps a closing VIX strangle on the short side. Looks like today the 1827 strangle went up in March about 57,000 times. Paper selling both, selling the puts for 65 cents, the calls for a clear penny. So clearly, hopefully that's closing. I hope no one's out there opening for a penny. But still, that was an interesting one. Did this one catch your eye, Mark? And any other big VIX trades kind of catch your eye this week? A bit of an interesting week overall, but slim pickings from the size trades perspective.
Yeah, I mean, what we saw was a lot of risk reversals trading, and you did start once VIX got below, once VIX really got below 19 and 18. You saw some traders starting to step in and hedge. Interestingly, a lot of these guys are hedging Fed risk. With the March contract, with the idea of playing a kind of a vol rally the Monday and Tuesday ahead of the Fed. So despite the fact that the Fed doesn't include any specific, any kind of that next week's is going to be expire before the Fed actually announces, you still have a lot of activity in the medium-sized VIX range, the 1,000 to 10,000 size. Trading where people are buying calls, they're trading risk reversals, they're doing things to get long exposure to the VIX. Some of it anticipatory, and maybe some of it hedging.
Go ahead, Mr. Rhodes.
I was just going to mention that, Mark, you nailed it with the. I was in the VIX pit when that one trade went off.
That's closing strangle sale.
Yep. So I think you described it perfectly. I was just going to reinforce what you were saying.
Well, whenever I see one leg going up for a penny, I have to just hope that it's closing. On the sell side, anyway. Yeah. Mm-hmm. If someone's opening for a penny in VIX land 60,000 times almost, then I have to question other things aside from that. And there's enough size, like there is on every strike in VIX land. There's enough size on both of these strikes to accommodate from an open interest perspective. About 200,000 or so on the calls and about nearly 200,000 on the puts. Speaking of the hot strikes, let's dig into what people have been slinging and what the big open interest positions are out there in VIX land for the week to come. And the number one strike, surprise, surprise, still those March 30s size open on that strike, about nearly 500,000 contracts, 486,000. That is clearly far and away the most popular strike, as including some of those spreads we were talking about on recent episodes, going up with legs on that 30 handle. Right now seems ever optimistic, but you never know. The volatility regime can change, as Russell's Uber drivers have been known to point out to him in the past. The number two strike, the March 35, is even more optimistic, but well south of the number one level. Only about 308,000 contracts open there. Then we fall off a cliff again. 232,000 contracts open of the April 25. So got a little bit of April love. Number four, go all the way out to May. So May getting on the charts with the May 30s. About 230,000 open of those. Number five, the March 27th, 216,000. And then pretty much you got to go pretty far down to find a put here. Number six, the March 40s. Ever optimistic March 40s. About 206,000 open up there. March 23s, 202,000. Number eight, the April 30s. Number nine, the March 25s, both with exactly about 200,000 contracts open. And all the way down at the number 10 spots, we see the lone put on the hot options list, the March 18 put of infamy of this strangle earlier today, 159,000 contracts open there. And that's pretty much it. Total about 7.5 million contracts outstanding. That's a fairly decent chunk. 5.5 million on the calls, about 2 million on the put. So a lot of things kicking off. Anything else, Russell or Mark, on the VIX options activity side for the week before we dive into some of the other big VIX related and just volatility news from the week that was? I'll take your resounding silence as a no. As we move on to the other big story of the week. Mark, I know this one caught your eye. Russell, you are excused from this conversation, I know, because you guys over there at CBOE, you like to kind of analyze new products, sink your teeth into them, look at them a little bit before you talk about them openly. But you know what? That's never stopped Mark and I before from diving into the fray on some interesting volatility-related products. And if you were paying attention at all to the volatility space this week, listeners, and I'm assuming you were if you're listening to a show like this, then the big news of the week was, I don't know, I'm calling it SPY-X. They want to call it spikes. I'm not going for that. If you're going to go try to make it as close to the spelling of VIX as possible, then just own it. Just go SPY-X. So I'm calling it SPY-X. If you're not familiar with this, listeners, this was announced by over there at BATS this week. It is the latest entrant into the ever popular volatility fray. You know, on the show we've highlighted a bunch of alternative products in the past. Of course, the Real Vol guys. We of course had Scott Nations talking about his skew decks and skew. I forgot the name of that. Yeah, there's a bunch of them out there. This is the latest entrant into that space, which is, like I said, SPY-X coming out of BATS and the guys over there at T3 doing a kind of a combo to produce this SPY-IX, aka SPY-X product. And essentially what they're trying to do here is pull the implied from SPY versus the SPX. And it's interesting. The pitch around this has been kind of interesting. That's probably caught your eye as well, Mark, because it seems like the entirety of the whole thing, it has been pushed back to that very brief 30-minute or so period back on August 24th when the market was melting down. And for that short period, VIX did not disseminate a quote. And apparently the entirety of the genesis of this product has been in response to that. At least if you believe everything you've read coming out of BATS on this, that their whole thing is that SPX, which is where, of course, the VIX vol is derived from, that's still predominantly pit traded. They want to have this purely automated process, aka going to SPY rather than SPX and pulling the implied vol off of that. Other than that, it's fairly similar. I'm curious, what's your 10,000-foot perspective? We don't know all the details yet, but what's your 10,000-foot perspective?
It will be interesting to see what CBOE has to say from a legal standpoint on this product. Two, as much as SPY and SPX are similar, there are some areas where they're really, really different. Most notably is SPY tends to have a much steeper skew in relative terms to the VIX, and it's not like some of the areas now that they've moved to this weekly. It's not like SPY is always super tight outside of the first couple of weeklies. So it's not as cut and dry, and again, I think that it'll be interesting to see whether that actually makes any inroads. If you watch VIX, there aren't many actual VIX traders or VIX people that actually pay attention to the cash index that much anyway. It's almost always and entirely what are the VIX futures doing and what are the VIX options doing and what's going on there. And that stayed relatively liquid last I checked during that market. And so I'm less inclined to think that there's going to be a lot of demand for this product, especially with I would be more impressed by this product if the partner was, let's say, Societe Generale or, Barclays. I like the T3 guys, but not exactly an investment banking powerhouse.
It's interesting just looking here, and you're right. That notion of SPY having some interesting issues. Anyway, there is kind of this kind of golden goose notion in the volatility world of trying to chase this spot VIX. How many times have we seen it with the VIX up, VIX down? That, of course, didn't really work out perhaps the way they planned. So a lot of people are trying to chase this golden goose of spot VIX. None of them have really delivered. I'm not sure if BATS will be the one. I guess we'll see. They did talk, our friends over there, I think this was Bloomberg, talked to Bill Speth, VP of Research and Product Development over there, CBOE, because they asked him specifically about the whole August 24th meltdown, which is kind of why this product has been pitched. And he said, which I think a lot of people would agree with, August 24th was such a rare occurrence, we have no plans to make major changes in the VIX calculation at this time. And we talked about that at the time. Remember, it was kind of just, it seemed like it was the incorporation of the weeklies that caused some of that hiccups to be disseminated. And it was a new iteration to the calculation at the time. It was kind of a perfect storm of events that kind of caused that.
VIX Mo never stopped quoting.
Yes. people have this belief that, it all shut down. It's just the dissemination of that product. So, yeah, the notion of pitching it all around this is kind of interesting. Yeah. I mean, just from an interest perspective, I always like to see a lot of different people trying different tilts at the windmill to see what sticks out here. We've seen a lot of people coming into this space. None of them really have ever gotten any appreciable open interest or volume yet. In fact, it's funny, they did reach out to ISE, the late lamented ISE now, as a part of this article here in Bloomberg, and they asked them about their Baldex, which of course we had on this program about a year and a half, and of course we haven't heard hide nor hair since then. I know a few of you have asked me about Baldex in the interim. I've reached out to ISE several times, and the result is the same thing they said here to Bloomberg, I believe, which is no comment. And it seems like the sticking point that I've heard, Mark, and maybe you've heard something different, but the sticking point for all these products, the reason why we haven't seen a Baldex in the marketplace yet, and the thing I'm still waiting to hear about from the SPY-X is an underlying. Yeah. People, if they're going to trade this for size, if you're going to use any sort of hedging activity with it, you need to have an underlying to drive options volume to hedge with. They haven't said word one about an underlying for the BATS product, which makes me wonder. That's been the huge sticking point for the Baldex, no underlying. Yeah. So unless you have a future or something else like that, maybe in certain scenarios an ETF, but probably a future.
Yeah. Well, we saw how well those vol ETFs worked out.
Yeah, it's kind of hard.
VIX up, VIX down.
Yeah.
Although they should. Yeah, VIX up, VIX down. They should just call it VIX no trading.
So I'm curious to see how this works, but I think like every other entrant we've seen in the space, until I see an underlying announced with it, I'm going to be kind of skeptical for any of these things kind of having any purchase in the broad volatility space. But let us know, you guys maybe in the chat, even listening live, if you have some thoughts on SPY-X or whatever you want to call it right now. Let us know. Meanwhile, a lot of you guys wrote in with questions about our wrap-up and our rundown from the CBOE RMC conference. So I think without further ado, we'll get into that, a little bit of an extended version of our volatility voicemail today.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. Welcome back to the volatility voicemail. Like the man said, this is the portion of the show where you guys get your chance to fire off at us with your questions, your comments. Those of you in the live chat, if for whatever reason, the easiest way to do it, of course, set up a Mixler account and just fire away in the chat room. But for some reason, if you don't want to do that, you don't want to add yet another account to your ever-growing arsenal of online accounts, I can certainly understand. Hit us up on Twitter or on Facebook, and we'll try to route it through in the appropriate amount of time. Meanwhile, we have a lot of stuff to get to here already, starting with there's a theme, I think, to a lot of the questions this week, Russell and Mark, and that is we talked a lot about put selling last week. A lot of the questions are about put selling. Let's start off with this one. Well, first off, a comment from Chic or Chick9 selling puts equals blowout. We can get to that in a minute. A lot of the data last week perhaps contradicting that very prevalent viewpoint. And then we have an actual question here from Nick S. He writes, hey, why was there such an emphasis on selling puts at RMC? Isn't that an old strategy? And it kind of is. You know, Mark, we were joking about this before. Everything old is kind of new again in the trading space and in the volatility space. And you could certainly say that about the put selling love. I mean, it's not like put selling is new. We were joking about it with our old friend on the show here, Don Schlesinger. He was very much ahead of the curve 30 years ago with his put selling bonanza over there in Morgan Stanley. That man has sold quite a few puts in his day. But that said, it is kind of interesting that everything kind of thematically settled around put selling. Russell, you were involved in a lot of the planning of these conferences. Was that a conscious effort on your guys' parts, or was that just kind of the way the research shaped up this year?
Well, I don't know how accurate that statement is. The point put selling was so emphasized. It didn't seem to be that big of a deal there. My feeling was that we talked about a lot of different strategies, but that one just came up a couple of times.
So you're contradicting our listeners there.
I was there. So, no, but I do think when we were talking last week and we were doing a recap of it, that we spent a lot. I recall we were sitting in the room just at the end of risk management, and the three of us spent probably more time, a bigger percentage of our time recapping the conference than selling puts being emphasized. Now, I think one of the reasons that that it may come across that we were emphasizing that is because we have introduced 3 white papers about selling options that CBOE released going into the conference. So you've seen probably an unbalanced amount of social media about put selling strategies because that's something that we had some really nice findings in those papers from. And the reason being, it's not that, put writing hadn't been around forever or that we found something new. It's just that the studies that we commissioned noted that put selling continues, if anything, to be a successful method of, for lack of a better way to put it, beating the market on an absolute and risk-adjusted basis. And, I have such a systematic trading background that I probably spent too much time talking about that. But I think that the reason that there was an emphasis that's coming across that there was an emphasis is the papers that have come out recently and the introduction of about 25 new strategy benchmark indexes based on Russell 2000 and SPX options. And the ones that seem to have the best performance are the ones that involve selling puts, not necessarily selling calls.
Yeah, and Russell, I would say that, is it an old strategy? Have we known about put writing and selling puts for a long time? Yes. But is it something that's finally hitting the mainstream with some of the pension funds and some of the, let's call them less nuanced institutions where they're using it as a let's call it a smarter way of trading a long portfolio? That is newer. Goldman made their presentation on the bond buyers equity basket, and that was all put selling. And it's not something that has been out for a long time. So it's more of the fact that put selling is finally catching up to covered call writing as a mainstream institutional product. And I think this year was the first time that it really was blaring that a lot of the firms have caught up on, hey, you should sell puts if you're going to do covered calls as well.
Yeah, I think that's something listeners need to keep in mind, too, is that, even though we talk about a lot of things on the bleeding edge here on this program, the big institutions are slower to adopt a lot of these things, and rightfully so. They need to do their due diligence first.
There are still firms that Mark, there are still firms that you need a different level clearance to sell a put versus a covered call. That's what we're dealing with here, folks. So they're moving one of these big brokerage firms and these big pension funds is, your individual trader is like driving a cigarette boat, whereas a lot of these pension funds, it's more like moving the USS Enterprise aircraft carrier.
Yeah, I've heard a lot of them trying to make their arguments, even for something as simple, you're right, as a covered call. They have to bring reams of data. And it's as much maybe convincing themselves at these conferences and their boards as it is convincing any listener that, hey, these strategies are effective.
I'm smart. You're smart. We're all smart.
And as for selling puts equals blowout, that's kind of been the conventional wisdom for a long time.
That's not true.
You can do it, as these studies prove, you can do it in a much more nuanced way.
And you can blow out owning stock.
Yes, of course.
All right? You can blow out in all sorts of ways. I've seen a lot more people blow out selling calls than I have really, blow out selling puts, sans a 6-month period in 2008. Selling puts in an unnuanced way against as a addition to a bunch of long stock is called leveraging yourself. Selling puts as a replacement for equity is called capturing premium in a plus premium in a risk-adjusted return.
Yeah, and there's a lot of data backing that up. And your point is well taken as well, Russell, that we did hit on a bunch of those other studies in addition to what we talked about at RMC, and that's where they also touched on a lot of the premium harvesting aspects of Russell weeklies versus monthly Russells and SPX weeklies versus SPX monthly puts. So we had some additional data we were talking about here on the show that wasn't discussed at RMC. So maybe in context of all of it, there was a lot of put selling data, but it all came out at the same time. So we had to sink our teeth into it. And continuing on the put palooza, we have a question here from JV. He writes, can you explain the free cash flow yield theory and why it would help improve strike selection for selling puts? If I'm not mistaken, this was the Goldman guy on that side. I came in part way through his talk, so I missed the beginning. But as I remember it, he was talking about him using free cash flow yield as a way to select his put strike. Correct, Mark? Did you hear that whole talk?
Well, he's using it to select his stocks that he wanted to trade. That was more specific. And it was interesting. And there are a lot of different ways of examining stocks. His point was that they think free cash flow yield is more consistent than earnings per share and things like that because it points toward the business operations producing cash as opposed to anything you can, a lot of things that are done in accounting. Russell, I know that you caught that. If there was some stuff on strike selection, I missed it.
I don't think it was necessarily strike selection. It really was more of using free cash flow to pick the stocks, and he was equating the free cash flow to being kind of like income from a bond, where if you know that if you've got a confidence that free cash flow is going to continue flowing into a company, that you should be pretty confident owning the stock as well, because eventually it's supposed to flow through to you, which that's theoretically what's supposed to happen when you own equity. I don't recall, and I actually was scrambling through my notes while you guys were talking, I don't recall him exactly choosing the strikes, although I think in a roundabout way what he was saying is using free cash flow as a valuation basis, and what kind of yield of what is the percentage of free cash flow per share at certain prices, and then maybe selecting the put strikes in that way. That may have been as a one-off how the strikes come into play there.
It was a really well thought out piece. I got to actually sit down and chat with him for a while after his presentation off the record, and John Marshall. Not of any of the law schools or the Supreme Court, but the head of derivative research at Goldman. A really thoughtful guy. Really enjoyed what he had to say. And if you want to know what he told me, you should have been there. That's what I'll say.
Teasing our poor listeners.
I am. I'm like. I'm like a belly dancer. I'm teasing so much.
A very frightful belly dancer.
A hairy, overweight belly dancer.
I guess there's a market for all those things, sir. Let's see. Moving on to
short too. Don't forget that.
Yes, that's true. Question here from La Beach, LA Beach 2. I'm not sure what.
LA Beach 2. I see. I thought that said La Branch there for a second.
And he or she writes, "Hey, ratio verticals work in VIX. What about SPX and SPY? Sell one, add the money, buy two, out of the money, to hedge and spec." Why no studies on that? Seems better than just blasting away at the money puts. Let me just translate some of this. He's got a lot of stuff in here in this question. Of course, we touched on our wrap up last week. One of our favorite trades from last year in the VIX options, which was selling the 1/2 ratio out in the VIX call side. So selling one somewhere on at the money, buying two, some percentage out of the money. That seemed to work pretty well, particularly getting into the Q3 portion of the year when things were just rocking and rolling. Then that was, of course, discussed in one of the presentations at RMC, as well as in addition to the efficacy of that in certain scenarios versus the VIX calendar. Kind of interesting. He's asking how come no one discussed at RMC the flip side of that, which is selling the one at the money put, buying the two out of the money, kind of the old reverse ratio there, a.k.a. the Taleb put spread. We discussed that at length a couple of years back when we were debating black swan type trading and how you would think someone concerned about tail risk would hedge versus how Taleb and some other firms actually do a lot of their trading, which is exactly what he's talking about, selling at the money premium, buying out of the money. So you kind of are setting up for those extreme movements in that. I did not see, Russell, you saw everything there, so I was kind of going back and forth and also talking to people doing interviews, so I didn't see any presentation. I did not see any studies this year, at least, on put ratios in SPX. Was there anything out there that touched on this?
There was one of the sell side analysts spend a lot of time talking about getting tail risk by buying 10% out of the money SPX puts, buying 10% out of the money and selling 20% out of the money and going far out, which I thought was a pretty interesting approach. And she had a really cool comment. And when I say 10 and 20%, I mean 10% and 20% off the high, so not where we are right now. And she said, you typically are not going to get much more of a follow through after you hit that 20% point, which I thought, which I don't know if you can necessarily go way back and quantify that with options, but even if you just get the protection from down 20 to or from down 10 to down 20, you're a long only portfolio manager, it's not going to cost you much to have that exposure, and you are going to look like a rock star at the end of the year if the market's off 10 or 15%.
Yes, indeed. All right, moving on. See, we got time for one more here. This one comes from Jay Peach. He or she writes, I really enjoyed your wrap-up episode from the CBOE conference. Well, thank you, Jay Peach. He or she goes on to write, I thought the discussion about the pension fund manager panel was particularly interesting. I have two questions. One, what percentage of pension funds out there use options in some capacity? That's the holy grail question. And the number two, is the CBOE going to make that panel available to the public? Well, Russell, you can probably answer number two pretty easily. Are they going to put any of these panels out in terms of the recordings of the video from RMC, Russell?
No, we didn't tape any of the presentations this year. And really the reason that we don't is we get better discussions. To be, to be very straightforward about that. It's one of the reasons that we're able to get buy-side and sell-side people that will be so forthcoming at the conference, and it's because they feel like they're only sharing with what they know with the people in the room.
Yeah, it's always frustrating to me because we like to record that stuff and put it out to our broad network, and it always amazes me that people will say something to a room with 200 or 400 people in it, but not to thousands or tens of thousands. That kind of always perplexes me. But that's a conversation for another day. The first question, what percentage of pension funds out there use options in some capacity? I used some of the best sources of data out there in the past were the guys over there at OIC. They had a whole institutional arm that spent pretty much a lot of their time working with these funds, trying to get them on board from an options capacity. And they, of course, have done some studies recently. The institutional team, I think most of them aren't there anymore. But on the advisor side, they've done some great studies. I've seen some numbers on advisors and asset managers in that capacity, but I haven't seen any numbers specifically. Maybe I'll have to go dig through some of their research and see if they have anything that I can pull out on pension funds. I don't know, Russell or Mark, you guys familiar with any studies that attempt to quantify it? I know the percentage is going to be alarmingly low. Whatever you think it is, probably cut it in half.
The question is how many of them do it themselves? It's hard to kind of pull that into one number because on one hand you'll have ones that do it themselves and ones that do outsourcing where some of those funds are doing it. So it's a very convoluted question. I would say less than 50%, though.
Oh, well less than 50%. I would think well south of the 25% level, probably less than that. Mr. Russell, where do you fall on that?
Probably about a quarter right now, but 25%, like you said, but it is growing. And we had that panel discussion where they were talking about how more open the boards are being to allowing options. And I was actually at a college student conference yesterday, and I was talking to one of the professors who also is involved with the pension fund at the university, and he said they are actually getting ready to at least allow covered calls, which has been a first for that university's endowment. So, and then they're going to actually let the students do some covered calls as well in the small part that they let them manage. So it's not like a stagnant 25%. It's definitely growing.
There you go. I guess back to the question we had before. Why is there so much research on things that are as apparently basic as a short put? And that's because people are still coming online to covered calls right now and stuff. So we need this baseline data before we can have a dramatic increase in the percentage of funds out there slinging options. All right. Speaking of slinging, it's time for us to move on into our final segment in an attempt to predict the volatility future in the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into The Crystal Ball.
All right, everybody, welcome to the Crystal Ball. Again, the portion of the show where we attempt to divine what those ever-fickle volatility gods hold in store. Really quickly before we do that, I knew last week we weren't going to have a traditional episode. It was going to be more of our wrap-up show, so I kind of cheated. I let the listeners do the Crystal Ball last week, and I asked us out on Twitter, our audience there, where they thought, what we always do on the show, where they thought VIX cash would close on Friday, March 4th, so last Friday. And, of course, I gave them a range. At the time, VIX was hovering in the low 20s, and I gave them the choices of between 20 and 22.5 and 25, below 20 or above 25. What do you guys think won the rankings there? Mark, we'll start with you.
You know, I would say that, we'll be above 20.
Definitely above 20. About 75% of the vote was above 20. So that kind of shows you where people were leaning. Mr. Russell, what do you think won of all those?
You know, I'm disturbed by Mark's response, and I'm going to tell you why I'm disturbed by Mark's response. Is a few years ago, I was at home in Memphis, and I'm watching CNBC with my sister, and she'd never seen Jim Cramer before. And she goes, that guy sounds like you because everything he says, he's certain of it. And I always feel like that about Mark Sebastian, that everything he says, he's certain of. And that is the most uncertain that I have ever heard Mark in my life.
Well, I was thinking.
I mean, listen to him.
I was thinking and confused. I wasn't sure.
That's the only thing you take umbrage with to Mark Sebastian. I can make a list for you, sir.
Russell.
The lack of conviction at that answer out of you was just.
I know. Well, my father normally says, "Seldom right, but never in doubt," and that has been my mantra. But today I wanted to be a little more thoughtful.
Okay, well, I mean, say it like you mean it, dude.
All right, I'm gonna say above 20, Mark.
There you go. I'm going for a 15 handle, and the low for VIX will come in next week.
I think Russell's a little bit ahead of us here, but I was saying for who won the poll, it was the 22.5 to 25 range, with about a third of respondents choosing that. Net aggregate, about 75% of people all choosing above 20. Of course, where did VIX cash close? Where did VIX cash close? About 16 or so last Friday, 16.5 or so, somewhere in that range. We did have one listener write in with a very prescient 17.34, which kind of surprised me, which is actually about almost exactly the high of the day. So that was pretty. The game last week was, of course, how would non-farms affect everything, and clearly non-farms wiped all the vol out of the room. Like I said, here we are recording this right middle of the session here on Friday the 11th. VIX cash taking a bit of an uptick now. Back above 17. Back above the 17 handle. So we turn I lost track of who won. We didn't have one last week. The listeners all collectively lost. So we'll turn our attention to this week. Let's say I'll go first just to make it fun. Sure, you guys always complain about you guys never go first.
I'll go last.
I don't have to be in the strangle range of you two, which is more fun.
I'll go last.
I'm gonna say at this point we're hovering right about at exactly a 17, and I'm gonna say we're gonna be a little bit elevated towards the end of next week, or end of next week, yes, but not extreme. I'm gonna say about an 18. I'll say 18 to 18.5. How about that? I'll be nice and specific. If you guys give like 5 handle ranges, I'll give a half handle.
All right.
So, Mr. Greasy Meatball, you can go next, sir.
Well, no, let's let Russell go. I'll go last.
All right. Russell, you get to make the other side of the strangle with me, and then Mark will squeeze in the middle.
I'm going to say somewhere between 15 and 20.
You've been watching Prices Right on your channel.
What I was blurting out before. I actually think I think early next week we might see a 15 handle, but we'll probably finish the week closer to 18 or so. So I think a dip and then a move higher.
So that's the challenge always, is where it closes on Friday. You can say, there's a lot of things in between, but like last week, it was elevated in the morning and the non-farms kicked the crap out of it. So Mr. Greasy Meatball, we're actually you're saying 18 as well, Russell, just to clarify?
I'll go 18, but I'll say 17 and a half just to go below you.
Give a little bit of Prices Right.
I'll tell you what, Mark, I'll give you all the way above 19, and I'll take the over.
Okay. So a tighter strangle than we're used to having for the crystal ball this week, and I'm gonna put Russell in at a nice 17.5. He gets the specificity award of the week.
You got a tight market there, Mark. You got 18 to 19.
I know,
basically.
that's pretty good.
Yeah,
I'll take it.
I would say that I've got the biggest upside, although really, getting above a 19 may be difficult. But hey, from a statistical, if we were trading this, that would be the play.
Blipping above 19 may not be hard. Sustaining and closing above 19, different.
I'm an expert at blipping.
Yes, you are, sir. All right, and that's going to do it for the the crystal ball segment. It's also going to do it for this episode of Volatility Views. But before we go, as always, let me check back in with each of my cohorts here, my partners in crime, see what they have cooking. Starting with you're in the room today, Mark. So you get pride of place. What's cooking in the land of Carmen Line and indeed Option Pit?
Carmen Line, we're just trading away, and at Option Pit, one, read our blog every day. We're going to post some really awesome stuff up there around volatility, and then two, if you make sure you're on our email distribution list, because we're going to be having a webinar late next week that will be chock full of valuable information.
Russell's getting the call saying the show's going too long, so really quick, Mr. Rhodes, what's cooking in the land of all things CBOE?
I'm going to FIA next week. I'll see you down there for sure. In fact, I want to make sure that I get your information because it's such a big deal. It's difficult to track people down. So we'll be doing that. And then Friday, I've got to go out to California for a couple of things as well. So another week full of travel.
So are we going to need a substitute for you next week, Russell?
Dissertation topic by the end of the month. So if anybody's got an idea, feel free to help me.
So are we going to need a substitute for you next week, Russell? Are we going to be Russell?
I don't know yet. I got to look at my... No. Actually, I made my flight at 5 p.m. on Friday.
Oh, nice.
So I would be available to talk to you guys.
It's nice that you schedule around the Volatility Views podcast, because I know I do.
Everyone sets their watch.
I'm going from Fort Lauderdale to San Jose, and I'm leaving late in the day just so I can be here with the guys that I love.
Aw. Do you know the way to San Jose?
I've got a warm fuzzy, Russell. And speaking of setting our watch, we failed to set our watch today because we are a little bit long. That's what happens when we talk all things volatility. We get a little bit excited here on the old program. But that's going to do it for this episode of Volatility Views. On behalf of the Greasy Meatball and the Where's Russell / Russell's Weekly Rundown / Mr. Corner Office, call him what you will, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. And, of course, for tuning in live. If you mixed it, surf on over to Mixlr, MIXLR, every Friday, noon Central, 1 p.m. Eastern. You can join us for the fun behind-the-scenes chat. See how the sausage is made here on the old Volatility Views program. Of course, thanks for downloading, streaming, subscribing, all the fun stuff you do, and sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.